Hi, this is Bitcoin Asset Research with Allard. Today I want to talk about the implications of IBIT options approval by the SEC. This is going to be a summary of an article I did on Seeking Alpha published earlier today. Now the SEC just approved options for iShares Bitcoin ETF. This is IBIT, this is BlackRock's spot Bitcoin ETF. The OCC and CFTC still have to approve, but this is basically a given now that the SEC has greenlighted it. This is huge for Bitcoin. Every single major asset has very deep options markets, every single one. There's no exception to this. The tier 1 options really look like SPX, SPY, XSP, QQQ, IWM. These all have daily expiries or 0DTE options that expire every single day, and they all have massive volumes. Now the first three, of course, are the S&P 500. SPX and XSP are both index options. SPY is the Spider S&P 500 ETF. QQQ is the NASDAQ 100 ETF. IWM is the Russell 1000. The tier 2 ETFs, we have TLT, which is long-dated US government bonds, HYG, which is high-yield corporate bonds, GLD, which is gold, SLV, which is silver ETF. Now they all have weeklies and also massive volumes. Each of the Magnificent 7 stocks have very liquid option markets. You can see here on option charts, this is a very useful tracker for active options. And by ETFs, you can see all of the tier 1 and tier 2 ETFs that I've talked about here. And then in terms of stocks, each of the Mag 7 is here. We have Nvidia and Tesla leading the race. Now, Bitcoin is about the size of silver in market cap, yet decent BTC options haven't really materialized for US investors. So what do I mean by decent? I basically mean capital efficient. You can cross-margin it with the rest of the assets in your portfolio. The options themselves have tight bid-ask spreads and a lot of different days till expiry to choose from. Deribit happens to be the top crypto options exchange. You can see here on Deribit, this is BTC options, has many different strike prices and a lot of different expiration dates for you to choose from. Now, unfortunately, Deribit isn't actually open to US persons. What is open to US persons, I talk about in this LinkedIn post from 7 months ago. I mentioned how Americans are really at a big disadvantage when it comes to protecting our Bitcoin positions. Bitcoin derivatives are very lacking, but when it comes to hedging with options, these are really our venues for doing so. LedgerX is a regulated options platform, is regulated under the CFTC, but it's very capital efficient. You can't really do any naked trading. You cannot long short spreads without covering the short leg, and you also have to wire in your money, which is really just awful user experience. Like, imagine having to pay $20 just to fund your account. Now there's also options on MBT and BTC contracts, so these would be options on futures, but they're more complicated, they have more regulatory fees, and the bid-ask spreads are huge. Of course, you can also use stuff like MicroStrategy options or BITO options as a substitute, but these have a significant tracking error to the real price of BTC. And I called here about 7 months ago that it would very likely be IBIT who ends up getting options first. And this was the thing that I was hoping on 7 months ago, and now it seems it's come to fruition. So IBIT options fix this issue of having a capital efficient, low bid-ask spread option for hedging. It's going to be cross-margin, which means you can use the buying power from your marginable securities to open positions that speculate or hedge against the price action of BTC. The unit size is quite small. IBIT is only $36 per share right now. So using the 100x option multiplier, every contract gives you a notional value about $3,600. So this will probably be very liquid and tight bid-ask spreads. Now let's talk about the implications of having a very liquid options market that is accessible to a broad base of US investors. So first one is increased liquidity. This one's pretty easy to understand. Options create more liquidity because they increase the underlying assets trading. Market makers need to hedge positions, so that increases BTC trading activity. As they hedge out their options positions, they're going to go into the spot market and buy and sell more BTC. It's going to increase volume. It's going to smooth out price volatility. It's going to tighten up those bid-ask spreads, so trading in BTC is going to be much more efficient. Large investors can enter the market with reduced slippage, and this, of course, allows people to come in with much larger pools of capital. And the result overall is more efficient Bitcoin markets. Now, the second impact is quite similar, but it's actually more of an effect of what options unlock via hedging. Institutional investors can now hedge BTC risk with IBIT options. So once IBIT options are out, they'll now be able to use it to perfectly hedge out certain price action risk that they have in mind of BTC. Now, they can design sophisticated trading strategies using these options, very highly granular and complicated. This opens the doors for much larger pools of capital to enter. If you think like the threshold to some of these guys entering is certain levels of risk that they find unacceptable, well, using these options, they can now fine-tune that risk to exactly what they desire to be. So the option give them the ability to enter this market at a risk tolerance level that is satisfactory to these larger pools of capital. So it allows that marginal pool of capital who's like sitting on the fence, it allows them to enter. And for this, you could really think of covered call funds, right? Like these are all the rage nowadays in terms of income investing. This is QYLD, the NASDAQ 100 covered call ETF. It just holds the NASDAQ 100 and then sells calls against the NASDAQ 100 holdings. And this has a total net assets of $8 billion. So that's quite a big pool of capital. Then you have the iShares Treasury Bond Buy Right ETFs. This just holds TLT and then writes covered calls on that TLT position. This also has about $1 billion in assets under management. YieldMax has been famous for its covered call funds on highly volatile stocks. So this is MISTY, which is the MSTR covered call fund. And here you can also see that they have quite a bit of assets under management. That's $500 million. So options are the most important derivative instruments. This is very, very obvious when you understand what they are. You can use them to construct anything. So forward contract, that's just long a put, short a call at the same strike and expiration. A move contract, which just bets on the underlying magnitude of the move, irrespective to the direction of the move. This is just an options straddle, which is long a put, long a call, all at the same strike price and at the same expiry. And a buffered return profile is also possible with options. Invesco has an S&P 500 buffer fund, and the description is that it seeks to provide investors with returns that match those of the S&P 500 up to an upside cap. Now, how is this done? Well, you can do it with options. Here is an options debit spread that does exactly what that was just describing. This upside is now going to be capped at this point where this green line is, and the downside is buffered at this point. So using options, you can very easily design this return profile that you absolutely know with certainty how it will play out. So that's just one of the things that you can do with options, and it allows these very complicated structured products to be created. If you like this video so far, I just ask you to like, share, subscribe, and comment. I started writing just to hear some challenges to my thoughts, and it's the same for these videos. I do appreciate constructive criticism. Now, this is the third impact. IBIT's dominance is going to keep growing. With the introduction of the options volume will likely centralize around IBIT. So newcomers to the Bitcoin ETFs will think one or two things, right? They'll think either one, I'll go with the ETF with options. This is the case where only IBIT has options. And they'll go with that because they'll want the optionality of selling covered calls or doing other kinds of related hedging activity or income generation activities using options. And two, they might think, I'll go with the ETF with the most liquid options. As IBIT gains that initial starter liquidity, everyone who's thinking this number two, they'll now go with IBIT, and that causes IBIT to get bigger and bigger. So this is going to be a long-term impact. IBIT's dominance is going to continue growing. Now, impact four, this is the more complicated part. We have to be aware of the unprecedented reflexivity given Bitcoin's scarcity and the dynamics of the option markets. And again, this is where things get extremely crazy and complicated, but just bear with me. Let's take a step back from Bitcoin and just talk about GME back in January of 2021. There was this meme stock short squeeze, and it was a very high profile event. Most people know it as a short squeeze. Over 100% of the flow was sold short, which, you know, is absolutely crazy at face value. You have to wonder how this even happened to start with. And the price action for GME really went parabolic. So you can see here on Yahoo Finance, I have pulled up GME. Prior to January of 2021, it was trading at single digits, mid-single digits. And then suddenly in January, it shot up to well over $100 a share. So this is easily a 25x increase. And this was really the initial rally, and then kind of crashed and then rallied again. So this was an extremely volatile trading session. And even to this day, the stock is very volatile. So many people don't know that GME got really crazy because of short-dated options or weeklies. So these are options that expire within like 14 days. Now, this is what's called a gamma squeeze. Gamma is the rate of change in an options price with respect to the price of the underlying. So I should note here that the rate of change in an options price with respect to the price of the underlying is called delta. So gamma is really a derivative of delta. Now, you don't have to know all about how that means. The mathematical derivations for this is very complicated. But just in layman's terms, you could think about it as price-based convexity. So what do I mean by convexity? Really, it's just being non-linear. So if the underlying moves up by 1%, you could see the option move up by far more than 1%. And if it moves up by 2%, it'll move, if the underlying moves up by 2%, the option will move far more than the 1% times 2. You see, like there's that non-linearness to how the option price responds to the movement of the underlying price. Gamma is highest when options are close to expiry and when the contract is at the money. So at the money just means that the strike price of the option contract is where the spot price is. So here we have a chart of how gamma works against various days till expiration. And you can see the at the money strike price, we assume it to be $210 right here. And the option with 14 days to expiration has the highest gamma. That's the red line right here. It's the highest gamma when it is at the money strike price, and it has the lowest days to expiration. Option dealers need to hedge out their delta by trading the underlying assets. So what does this look like? When lots of GME out the money weekly calls are purchased, the dealers are short the calls. So they are short delta and short gamma. Generally, just remember that with options, long options mean that you're a long gamma, short options means you're short gamma. So when weekly calls are purchased, the dealers sold the calls to the people who bought them. So now they are short gamma. And when they're short delta, they now have to get long delta. So they have to buy shares of GME. So what do you think happens when these dealers need to buy a bunch of shares of GME just because some people bought call options? Well, buying pushes up the price of GME, and it's going to go up even more. But when the GME price goes up, this pushes a lot of these out the money calls closer to the money, which means that their gamma is going to go up. Because remember, gamma starts maxing out once the option gets closer to the money, and it maxes out when the option is at the money. So this means that the rate at which delta is increasing gets even larger, right? And this is the gamma squeeze dynamic at play. So guess what happens? Dealers have to buy even more GME shares, because as delta gets larger, they now have to buy even more shares to hedge this negative delta. And when you repeat this process, you get exactly that chart we just saw, where it's just a hockey stick going straight up. The general term for this kind of feedback loop is called reflexivity. Markets exhibit reflexivity all the time. But here's the big question. Why does this stop, right? Because most squeezes crash right back to pre-squeeze price levels. So why does it go up and then come back down so violently? Why? So here's the wrong answer. The wrong answer is fundamentals. Now, I'll remind you that reality can be way out of touch with those fundamentals, right? Like we are currently at this stage in history at PE multiples that are far higher than the long-term historical average. The right answer is always supply and demand. Like you don't want to think too much about fundamentals here. The right answer is always supply and demand. When price goes up enough, supply is going to increase. This is the case for everything, okay? Shares of stock, that's exactly what happens. That's exactly what happened with GME. GME, AMC, all of those other meme stocks, the companies started issuing more shares and sold it into the rally. Of course they would, because the price is so high, it absolutely makes sense to issue shares and raise more cash to take advantage of this high price. But it also works the same way with natural gas. You can see here, this is what happened during a natural gas rally. Now, this wasn't a gamma squeeze or anything, but when Russia invaded Ukraine and the Western sanctions kicked in, suddenly Russia's natural gas was no good. So the price rallied parabolically. Like this is a very violent and intense rally in the natural gas markets. And then it crashed back down. In fact, right now it's far lower than what it was prior to the Russian invasion. So what happened? Well, producers of natural gas stepped in and they started producing more. And the more supply there was, that pushed the price down. So prices got back to the pre-squeeze levels. The same thing also happens with bonds and debt. If the price of a bond is really high, that means interest rates are low. People are going to issue more debt. And therefore, that is going to push back up interest rates, which pushes down the price of debt. It works for housing, gold, silver, etc., etc. All commodities, all assets, everything follows this simple rule. When the price goes up, the supply increases. And when the supply is created, the anticipation of this supply increase, that is what pushes prices back down. Not the actual supply increase. Everybody knows that the supply is going to increase, but the anticipation that it is going to happen, that is what causes the markets to start front-running people, and that's going to be what pushes prices down. There's only one exception to this rule, which is Bitcoin. There's only 21 million Bitcoin. That's a programmatic guarantee. So there's no incoming supply increase with Bitcoin when its price goes up. There's only weak hands selling to strong hands, right? So that dynamic that I just talked about, supply goes up when price goes up, that does not exist with Bitcoin. So when a short squeeze transforms into a gamma squeeze with Bitcoin, there is no supply shock that is coming to the rescue. And if a gamma squeeze happens organically because of a lot of IBIT out the money call buying, there is still no supply shock rescue that is coming. No one can create more Bitcoin out of thin air. This is going to look very different from other squeezes. You can clearly see that this is going to look very different because the underlying asset has this very unique quality. And everyone knows it. That's the thing. Everybody knows the reality of Bitcoin's absolute scarcity. Well, everyone that's like trading the markets and involved with it. So the likelihood that they sell into this rally is much lower, right? So when you have a rally in natural gas or GME, there is a likelihood that people who are long is going to sell into it because they know a supply increase is coming. And because they know that the supply increase is coming, they're like, okay, well, I might as well get out of this before the supply increase comes. Because remember, it's the anticipation of the supply increase that causes the selling. Now, I'm not saying no one will sell, right? Like people will obviously sell BTC even during the supply shocks and even during the rallies. Like there is going to be buyers and sellers. What I am saying is look at it apples to apples. GME gamma squeeze, natural gas gamma squeeze, or BTC gamma squeeze. Which one do you think the holders will have a lower propensity to sell? The answer is, of course, BTC, because of its absolute scarcity. The Bitcoin market participants, they know that there is no supply increase coming. So the likelihood that one of them sells is obviously lower. And it's because that it's going to be lower, that's what allows this very wild dynamic to emerge. So the reflexivity is going to get crazy. And from a valuation perspective, the approval of these options means that there is now a chance for this dramatic situation I'm outlining to unfold. So under a rational expectations model, right? So this is assuming you're like a risk neutral person and you just want to maximize how much money you're making. You can now incorporate the probability and payoff of this kind of wild gamma squeeze, no sellers event, and add that to the expected value of the asset. And when you do this exercise, obviously the probability is non-zero and the payoff is positive. So you're going to get a positive boost to the expected value. So this should raise the fair value assessment under rational expectations. Again, this is just a model. This is just a way of thinking about the asset from a valuations perspective. You don't really have to believe this. I'm just arguing that like this is going to be a factor when it comes to the valuation, and we can probably observe this factor in the form of a higher market price in Bitcoin in the very near future. So what's the risk to these options? I think IBIT dominance obviously creates this growing Coinbase honeypot. IBIT custodies with Coinbase obviously, and that's just going to mean more Bitcoin being custodied by Coinbase. So at any point, if there is actually a hack at Coinbase, this could be like a disaster. And also these options are very risky. They'll be very different from most options because the actual asset, the real BTC, that trades 24/7, 365, but the ETF and the options do not, right? IBIT trades during market hours and IBIT options obviously trades during market hours. So I personally would not want to be short volatility on overnight hours or during the weekend because I can't really stop out my position if BTC gaps 15% at 9 p.m. Eastern Standard Time. This is when the market is closed. So I would basically just be out of luck. I also have concerns about the options market possibly creating these edge cases. This could lead to random occurrences of very high volatility and possibly even IBIT experiencing NAV destruction. And what I mean by this is like it becomes kind of partially unbacked by the Bitcoin it's supposed to have. And look, I'm really just imagining this, and I'm really not trying to like spread FUD or anything like that. This is just some of the thoughts that I have around this. I imagine occurrences of very high IBIT gamma around Friday at market close that could force dealers to have to hedge out their delta by buying real BTC over the weekend. Let's say a bunch of people start buying IBIT calls Friday around the market close. Market closed, now it's very hard to get like IBIT shares off the market. So now to really hedge out that delta, these dealers have to go into the real Bitcoin market where the ticker is BTC-USD and they have to buy Bitcoin there. And when that happens, well, you have to realize that IBIT is in cash redemption. So they can't just trade in that Bitcoin and then get IBIT shares back. They actually have to like turn that Bitcoin into cash and then IBIT send the cash to IBIT's like fund managers. IBIT takes that cash, buys Bitcoin again. So there's this like lag in terms of price that could potentially happen, right? Because you're transferring real BTC to IBIT shares, but you have to cross by using the US dollar first, and that introduces potentially slippage risk. So I don't know how that will play out. I think that if there is this kind of risk, it'll materialize by spilling into the market for Bitcoin. So we could randomly see bid-ask spreads widen out a lot and order book depth suddenly thin out. Honestly, I'm just guessing for this last risk factor. Just let me know in the comments if you have any thoughts on this. So just to sum up, IBIT options, massively important moment for Bitcoin. It further cements Bitcoin as a major asset, just like all of the other assets that have their very robust and deep options markets. It opens the gates to more liquidity. All of this is very bullish. So that concludes the video. Please leave your questions in the comments below. Thank you for watching, and I'll see you in the next video. Bye.